would be more ideal. So 4 to 5 years of training data, I think it's is ideal. But in no circumstance you should train it with less than 2 years of data. But also there are sometimes it's not just a matter of length. It is that you want the training data to capture different regimes of the market. So for example, we want to capture regimes where the market volatility is very low, like present time, or in 2019. But you also want to capture data regimes which are extremely volatile, like 2020 or 2021 or 2022. So you wanted to have a mixture of different market environment, increasing interest rate, decreasing interest rate, and so forth. So given that kind of requirement, you would typically find that 6 years is a good number to capture the different sort of circumstances.
That makes sense. So you mentioned you input strategies and then your ML kind of looks through them. But I've also done a little research, and you once said that you could build a machine learning model that could output profitable strategies, maybe not like a 5-sharp or anything crazy good like this, but they can be good profitable strategies. How do you go about that?
Well, I mean, with the latest advance in machine learning, it is conceivable that you can use a large language model to learn from all the published strategies out there. After all, there are many blogs, many books, many papers that describe different strategies, and naturally you can use a large language model to digest them all. And if you specify a particular kind of risk profile, they may be able to regurgitate or recombine those elements that they have learned from these papers into a strategy. I have not seen anybody successfully publishing any work that, well, maybe they won't publish it if they succeed. But this is one area that I think it's not necessarily that the machine learning can come up with new strategy. It is that it can combine elements of strategies that other people have discovered and then put them together based on your specification.
What are the main features you're inputting into your machine learning models?
Well, features should be as many as possible. So, there's no such a, in traditional quantitative finance, there's a fear of overfitting. You don't want to have too many inputs. You don't want to have too complicated a model. You don't want to have too many parameters. But because we are using machine learning not to generate prediction on prices, but on predicting whether a particular strategy is profitable or allocating what amount of capital allocation to a particular model, the fear of overfitting is reduced. And also there are many standard methods nowadays developed to avoid overfitting. So generally speaking, you want to have as many input features as possible. And that would span the universe of price-driven variables.
Let's take a quick break from the episode, because if you're looking at a chart right now and stressing over a position, that means you're trading with emotion, and emotions trump your logical brain. So you're not going to be as profitable if you're trading by hand. Now, you might be a unicorn, but for the rest of us, I would definitely learn how to algo trade, and you can learn that in the Algo Trade Camp. Just go to algotradecamp.com, automate all your trading strategies, get rid of emotion, and get back to living life.
And prices would include any markets, prices that are equities, fixed income, futures, forex, options markets, indices would all be considered prices. So these are, and also you want to include fundamental data from various stocks, bonds, and so forth, or companies. You want to include macroeconomic variables, and so forth. So it's really, and obviously nowadays with large language model, you want to include sentiment. In other words, information that are extracted from unstructured data. Unstructured data can include most commonly text or even audio feeds, videos, and